acceleration that happens around the US election years, and this has happened every time, is what I refer to as the banana zone. So generally speaking, as I said, crypto markets tend to go bananas. So that is, we're talking currently the total market cap of crypto is about $2 trillion. By the end of this cycle, it'll be at 10 to 15 trillion. I mean, that's la-la land returns.
In a recent episode of the Julia LaRoche Show, renowned macroeconomist and investment strategist Raoul Pal dives deep into the complexities of global markets and the powerful forces shaping the future of crypto, equities, and asset prices. Known for his expertise as the CEO of Real Vision and his groundbreaking everything code theory, Pal explains how liquidity, debt cycles, and currency debasement drive market behavior, offering viewers a roadmap for navigating these turbulent times. From the cyclical nature of crypto booms to the influence of central bank policies, Pal's insights provide a compelling guide for investors looking to make sense of today's economic landscape.
So, I've talked about this at length about the everything code and how the entire economic machine is now driven by one key thing, which is liquidity. And that's now driving the business cycle. Liquidity became the most important thing in the world after 2008, when we had a global debt reset, but not how people expected. We had it by them forgiving all interest payments for a number of years. So everybody reset their debts, didn't have to pay interest, and everybody reset their debts at a 3 to 5 year time horizon. That's all the major governments in the world, from China to Japan to the US, the UK to the EU to Canada, everybody. And since then, the world has been on this cycle. Every time you refinance the debts, they add liquidity in. Now, the use of liquidity i.e. debasement of currency, to pay for the interest payments on all the debt is the thing that causes assets to go up, because the debasement is actually lowering optically the value of fiat currency. So it's a bit of a mind trick, and people don't see it and don't understand it. But this is why markets go up. And then, over time, I've looked how cyclical this is, and that it repeats, and we can forecast it into the future by using certain forward-looking indicators as part of the everything code. And everybody should go to my YouTube channel, see that video. So Raoul Pal, the Journeyman, see the video of the everything code. It is 2.5 hours long, but it is the most important thing I've ever put out. And so what we get is, bizarrely, it breaks down pretty much by year, not perfect, but so 2022 was macro winter. We had inflation. We had recessionary conditions in all markets. It wasn't called a recession in the end, but regardless, everything went down and everything went to shit. Next year, spring. What happens in spring? You get shoots of recovery. What happened? Tech stocks, crypto, things in secular trends did really well. But the business cycle remained low. So the forward-looking things, the things that are driven by liquidity, which leads the business cycle by a significant period of time, had started to recover. Then you get into macro summer. Macro summer is when the economic machine starts firing up again. And that lends to another acceleration in markets and growth, whilst inflation tends to be falling or subdued. And that's a really lovely period, because you can make money in pretty much everything. Commodities go up, gold goes up, small caps go up, crypto goes up, tech goes up, everything goes up. And that's where we are now. And so that summer period, the real footprint usually accelerates around the US election and after it. And that's when most markets have their best performance. So there is a seasonality around elections, which you tend to get strong first half of the year or first part of the year. Then it tends to be a bit more sideways, which we had in tech and we had in crypto, and where the rest of the market started playing a bit of catch up. And then you get the acceleration that goes on for the end of summer straight into macro fall, which is 2025, when really the best gains come of all. So that's where we are. So back then we were just starting. Now what happened? Crypto went on a massive tear, then had that sideways consolidation. Tech had a massive tear, had a sideways consolidation. The rest of the market's now catching up. And the next phase is the money shot. Both the end of summer, as I said, it doesn't actually fit necessarily with the end of the year. So we're still in summer. So basically, if you think late summer, the weather's pretty good. That's where we are. Somewhere in the middle of summer. So the weather's good. It's easy to make money. And this is the acceleration that happens around the US election years. And this has happened every time is what I refer to as the banana zone, where everything goes bananas. And in crypto terms, the charts just look like bananas standing on end because they just go vertical. Because around the election period and the year afterwards, they all have to refinance, $10 trillion of debt. The Fed has not been able to the Treasury's not been able to refinance easily. So it's been issuing short end bills, which is basically a holding pattern for rates to come down. Wait for rates to come down and then you can refinance your rates. It's like you don't want to refinance your mortgage at highs. You want to refinance your mortgage at lows. So you keep your money in a money market fund, which is basically what the Fed did. And then they'll do that. So that period of massive liquidity tends to debase currency. We're seeing China coming out with the cowbell, more stimulus. The US has started the rate cut cycle. That's going to come down a lot. The EU have started. The UK have started. Everybody started. And so the big game is at play. The rate cuts are actually a bit of a red herring. Liquidity really comes from central banks and governments putting money into the system. So we have something in the US called Fed net liquidity. So what is the three component parts of that state level liquidity? Well, that's driven by the Fed balance sheet, quantitative easing. They're still tightening, but they've reduced the amount of tightening. Then we have the reverse repo. And that is basically where banks mop up all of their funds. So if that's very big, money's tight. And when they start taking the money out, it goes into the banking system. The other side is the Treasury General Account, which is the checking account of the government. Now, if they've got a lot of savings and they're not spending it, which is where we are today, then conditions are tight. But once they start writing checks, what happens is that money floods into the system. And that is a kind of a net increase in money into the system. So if you make more of something and it's in abundance, its purchasing power or its value declines. So it's not that necessarily you and I get to borrow money more easily. It's not that. It's that there's more money around and it debases currency. It's like this magical thing that happens. Now, on the private sector side, the stuff like M2 growth and private sector credit growth is kind of a function of that, but they both work together because you can create dollars in a Eurodollar system. You can just create them out of thin air by being a bank. And so what happens is there is this huge increase in money that happens. But we as people don't generally get it. Sure, your mortgage rate may fall a bit, but really it's this debasement effect that happens that's more insidious that we don't see and don't really understand. Asset prices take off, but our earnings don't. So therefore we get poorer in terms of the assets we can buy. And an asset is just future deferred consumption. If you buy gold today, your expectation is you can sell it in the future at a higher price to protect your purchasing power. But today you can buy less gold than you could a month ago and less gold than you could 5 years ago and because your wages don't go up in the same as these scarce assets that move because of debasement, which is why property prices, I mean, when I bought my first flat in London, I was in finance earning a decent salary, but I was young. I was like 24 and it cost me 3 times my salary. If I were to look at the same kind of person, 24-year-old, work at an investment bank early in their career, the same apartment will probably cost 10 or 12 times salary. That's debasement.
Okay. So it is insidious, and maybe are we talking about just more like asset price inflation then?
Well, that's the way that people see it, right? What they're actually doing is devaluing the purchasing power of money by 8% a year, which is the increasing global liquidity. But most people don't understand it. And so what happens is you have a savings account, you think you're doing all the right things, and suddenly you still can't buy a house. And you still don't buy much, you can't buy as many shares of Tesla as you wanted to, and you still can't buy as much gold as you wanted to. And you're like, why? I'm saving money, I'm working hard, but I can never get up the ladder. That's what debasement's about. What you save in.
Yeah,
so
that too.
what it's done is cause everybody to become a risk taker. And this is an important point. So really, of all the assets that we monitor at Exponential Age Asset Management, there are only two that beat the 8% debasement plus, let's say, 2 or 3% global inflation. So 11% is the hurdle. The S&P keeps track of it roughly. The NASDAQ does 17% a year return since 2011, and Bitcoin does 140. Gold doesn't meet it. Almost nothing else meets it. So you're really herded into two assets only that can actually beat this thing and make you money. So your future self gets wealthier. So people have been incentivized to do that. Now, you might say, but this is crazy because people are taking such risk. But there's another piece of magic that happened is the Federal Reserve and the government understand that this is the case, and they understand that we have a lot of debt, and we understand that the collateral of the debt is the savings and investments of the population. So they don't allow it to go down much. So if you saw it last time, the S&P got down 30% in 2022 and liquidity came back. So they've stopped markets falling 50, 60, 70%. Sure, different stocks can, crypto, because it's not really a big part of the collateral system, but they don't allow the collateral to fall. So what they've done, what it means for all of us, is they've taken the big risk out. We've talked about the Fed put for years, but we didn't really understand what it meant. What it is for is, listen, if you've got a lot of debt, your collateral is what you pledge against the debt, right? The whole system is built on this. That's what blew up in 2008 because the house prices went down and everyone's loans were this high. But if you think of the whole system, all the banks and all the asset management firms and all the leverage and all the private equity and all of the stuff, they don't want the equity to go down because that's the collateral. They allowed the bond market to go down because in the end it gets repaid. So it's a mark-to-market loss. But in equities, when you've got this massive retirement system, you just don't want that. So this Fed put is part of the everything code where they've just stopped that event. So they debase currency to erode the debt, make the interest payments, because if not, they'd never be able to pay the interest because you'd eat up all of GDP growth just to pay this interest because it's 100% of GDP. And they stop the big bad event. So what that gives you is the greatest macro risk-taking opportunity of all time. Doesn't mean the business cycle's gone, but overall, you've got the best risk-taking cycle in history.
Right now.
Yes, and it's been going, and I didn't really realize it, but it's actually been going since 2010, and I didn't really see it, but now it's so clear that all the central banks understand what they're doing. They understand the entire game. They understand that they need to monetize the interest payments. Really, since 2012, it's super picked up. And we would not have had a recession were it not for COVID, because they've basically made it very difficult to happen. Because if you think of recessions, they're driven by the credit cycle mainly. And if you don't want credit markets to get stressed, then you don't have recessions.
Raoul Pal's insights into the global economic machine and the forces driving markets have offered a clear view of where we are and what might come next. If you found this discussion valuable, be sure to subscribe for more in-depth conversations with leading experts in finance, economics, and investing. Stay ahead of the curve by following Raoul's work and keeping an eye on how liquidity, debt, and central bank actions will continue shaping the world of crypto and beyond. Until next time, keep learning, stay curious, and navigate the markets with confidence. If you've made it this far, you must have enjoyed the video. So don't forget to give it a thumbs up and hit that subscribe button for more insightful conversations like this one. And if you want to dive even deeper, check out the next video YouTube thinks you'll love. Just click right here. Thanks for watching, and we'll see you in the next one.